BCE just beat Q2 2026 consensus on both the top and bottom lines, but they didn't do it by selling phones. Adjusted EPS came in at 65 cents, so that beats the 63-cent estimate, and revenue hit $6.18 billion, just edging past forecasts.
Yeah, and they reaffirmed all their full-year guidance, which is huge. Most importantly for retail investors, I mean, they maintained that $1.75 annualized dividend.
Right, the market loved that dividend defense. And the operating momentum, too. I mean, the stock completely shook off that pre-market caution and surged over 3% during the regular session.
It did, but digging into how they actually got that revenue beat, well, that's where the real story is. Because this growth, it didn't come from pushing hardware at all. It came straight from strategic services.
Right, yeah. Service revenue climbed over 4%, basically pulling the weight for the whole top line.
Exactly. Two main engines drove that, really. First, you have Bell Media having a fantastic quarter, up nearly 9%, and that is directly tied to ad dollars flowing in from the FIFA World Cup, plus, a massive 23% jump in Crave streaming subscribers.
Oh, wow, 23%. And then the second engine is Ziply, right?
Yeah, we're seeing the first real fruits of that Ziply Fiber acquisition. Their new U.S. broadband segment brought in nearly 55,000 fiber-to-the-home net additions. So essentially, they're aggressively laying the physical pipes for long-term recurring revenue.
Which they desperately need, right? Because product sales just fell off a cliff. I mean, they plunged over 16%. It almost feels like a car dealership, realizing there's no real money in selling the actual cars anymore, so they just kind of stopped pushing them.
That's a perfect way to look at it, actually. They are deliberately stepping back from heavily discounting those expensive handsets just to get you in the door.
Right, the subsidies.
Exactly. Instead, they want you on a bring-your-own-device plan. They're focusing entirely on selling you the monthly insurance, basically, the service plan. It's a strategic move to protect their margins.
Though it's interesting because maintaining that margin defense isn't exactly cheap right now. Like, even with adjusted EBITDA growing 1%, their actual margins still dipped slightly to 43.8%.
Well, yeah, growing those service revenues costs money up front. They had to absorb the operating costs of integrating Ziply, plus, footing the massive bill for those FIFA broadcast rights.
You have to spend heavily on premium content if you want to capture those ad dollars.
Right, and the streaming subscriptions, too. Which really brings us to where management is placing their bets. To pivot away from hardware, they are just completely rewiring where their money goes.
Yeah, highly aggressive capital reallocation. I mean, we're talking about a CapEx spike of over 41%, hitting $1.08 billion.
Because you don't just flip a software switch to become an AI and fiber powerhouse. You actually have to physically build the infrastructure.
Pouring the concrete.
Literally, yes. That capital is aimed squarely at expanding the U.S. fiber footprint and building out those Bell AI Fabric data centers, including a massive 300-megawatt facility that's currently under construction in Saskatchewan.
Okay, wait, I have to stop you there, though. Because of all this heavy spending, free cash flow dropped nearly 10%, down to $1.04 billion.
Right, it did.
And I know underlying operating cash flow actually grew by 11%. But if I'm an investor holding this stock primarily for that sacred $1.75 dividend, aren't they playing with fire here? Like, how long can management bleed free cash to chase this AI infrastructure trend before that dividend is actually at risk?
So that is exactly the core risk analysts are red flagging today. Management is placing a massive bet that absorbing this short-term cash flow pain will buy them long-term infrastructure dominance.
But the execution risk is just monumental.
Huge. As you pointed out, building massive AI facilities and scaling a U.S. fiber network, it takes time and it takes flawless execution. If they hit construction delays or cost overruns, well, that free cash flow buffer gets even thinner.
Not to mention they're trying to fund this transformation while dealing with their traditional business back home. The Canadian wireless market right now is incredibly competitive.
Very much so. And lower growth, too.
Right, which severely limits their pricing power on the consumer side.
Yeah.
I mean, they can't just easily hike phone bills to fund a data center.
Precisely. They do not have the pricing leverage to easily offset these massive capital outlays.
So here's a final thought for you to chew on. The numbers today looked solid, and the market clearly rewarded the top and bottom line beats.
For sure.
But zoom out, and BCE is aggressively attempting to morph from a traditional Canadian telecom into a North American AI infrastructure and digital media player.
So are dividend-focused investors prepared to stomach the capital-heavy growing pains required to get there?
That's the real question. Or will the sheer weight of these investments eventually threaten the very dividend defense that made the stock pop 3% today?
Exactly. It's the defining tension for the stock going forward. Make sure to follow the show for your daily earnings coverage, where we cut the fluff and get right to the numbers driving the market.